Fortunate that the HR group had a list of exactly what the splits were when. Otherwise,
Now, you'll get a statement that, that you're trying to figure the basis out. You look back on somebody's statement, 2007, and you see they had 100 shares, and at the end of the year they had 200 shares, and you go, well, did they purchase 100 shares, or was there a stock split? So actually I go out to Yahoo, and I go to the financial section, and I look at a stock, and see what a stock has done, so I can kind of estimate if it's split or not. Sometimes it will give you that information. Well, one of the questions, I guess the main question was, we're all interested in lowering our taxes. How do we do that? Good question. Yeah. One answer is have less income. No, you don't like that one.
Go to number two.
Number two. Well, you might not like number two either. Find more deductions. Okay. That sounds good, but how do you get more deductions? Well, get a bigger mortgage.
have a kid.
Have a kid. That's another. Have more medical expenses. That's not a good one either. One of the ways is shelter income. Actually you can still contribute to an IRA up to your 70 and a half. And, even though your Social Security could be taxed, once you get up to the $32,000, I know several of my clients will come in and their Social Security is taxed, and they're working just a little bit part-time jobs, try to supplement their income. And my number one key or suggestion to them, find something you like doing. Life is too short to, go back to work and do something you don't want to do. Find something you like to do. But also, if you do take another job, you can shelter that income. This is kind of a dramatic case. I know of a person who is in his 50s, and is now retired, has a very good retirement from the government, and it's going into consulting work. And he's expecting to make $150,000 in consulting work, which is almost, as much as he's making his old job. But you're able to setting up a defined benefit plan, and he can shelter the whole $150,000 and not pay tax on it. You're not limited at $6,000. You're not limited at $16,000 on the 401k. But there's plans out there that you can shelter quite a bit of income.
What do you mean by sheltering?
You don't pay tax on it until you start to take it out. It's like putting it into a 401k or into an IRA. But it's actually a combination of several things. In this particular case, he's a consultant. He's setting up his business as a S Corp. He's paying himself out of S Corp. He's combining his 401k. The company's matching his 401k. He has self-employed pension plans. He has IRAs. And it all comes out, we can almost shelter his whole income, which is amazing. But then once he reaches 70 and a half, he has to start taking the money out. And it's based on your age, there's actuaries, and there's some expense involved in setting it up. And it's not something you just want to set up for $4,000 or $5,000, but if you're doing something you like, you're doing some consulting work or something, you can shelter a lot of money. You can shelter, even set yourself up your own 401k plan. Set up a little business, put a 401k plan in, and pay yourself your whole wages into your 401k and have the company match it. You can shelter $32,000 easy. Yes?
One question that always comes up is, you really need to understand how much you want in qualified money versus unqualified. Because if you put all the qualified, then the estate taxes and that just kill you. I mean, it just really gotta be careful that you don't just, like you say, that person, if he's putting it into qualified money, at the end, there's gonna be a price to pay, it's gonna be very high. So you wanna really be careful how much is in qualified money. Is that a correct statement?
Yes. That, you asked me if it's a correct statement about, should you worry about if it's qualified for non-qualified? Yes. Qualified means it's in a 401K and you're gonna pay tax when you take the money out. Non-qualified is just money you put aside. And there's no rules or governing what you can do with the money. You've already paid tax on it. Whereas in the qualified, you're having to pay tax when you start pulling it out. And, yeah, and there are structures and how you can design a plan where you want to keep some of your money into the qualified and let it earn tax-free and draw money out of your not qualified earlier. And there's sort of balance on how you want to plan these things. But there's also some things, I know Bob was mentioning something, I think it's a Lincoln Advantage annuity, where you can put your money in, and then only 70 or 80% of it will be tax-free coming out of it. You can do the same thing with bonds, and put your money in tax-free bonds. But this will be your non-qualified money. So you'll be drawing money out of your non-qualified, and it's tax-free, and your money that you'll have paid tax on, you keep into your retirement plans till you get 70 and a half, to keep as much there as possible to grow without you paying taxes on it, and use your pre-tax, there's tax exempt, to take money out. Does that help?
Yeah.
Okay. And it's back to one of the things that there's a lot of different instruments out there, from Lincoln, MetLife. You go out to just buying tax-free bonds, PIPCO bonds. It depends on your situation, and also it depends how much you have in qualified versus non-qualified, and plans can be structured for what to do with the money, and how much money you need to live on. I remember a person I worked with, and he's 63 now. We used to laugh. We're going to be the person that, Walgreens handing out little smiley stickers, because we want to get the insurance. So we go work for Walmart just for the insurance to take care of ourselves. So that's something, you always look at, and it becomes a tax savings. So these things are, is a plan. It's not something to put together haphazardly. And a lot of times you need, somebody who's good and works with that can spend time with and understand your situation and get you on the right path. And looking back, and I don't know if y'all have this, feel the same thing, that I wish back when I was 25 and I was saving a lot more money. I even said that when I was in my 30s and 35, when I had kids and raising kids, and I'm taking all my money while putting my wife through school. I wish I had a good financial plan together, and I waited till I was in my 50s, and now it becomes even more important that I'm going to have to start living on my retirement. So you have to make sure your plan is a good one. One of the questions that was asked was about a stretch IRA. Are y'all familiar with the term stretch IRA? No. Well, one of the things is you have an IRA, and it needs to be taxed if you take money out. As a qualified, you can leave it with your spouse as a beneficiary. And then after that, you can have the next beneficiary as your kids. So now it still passes non-tax all the way down, through to your children. And your children then will have to take out required minimum distributions, but it's going to be a limited amount. So the money itself keeps growing tax-free. So you still have the benefit of the money growing tax-free. So you actually, by using the beneficiary function, instead of putting it into a state, you're able to pass it down to your kids.
But if you're 70 and a half, you can't do that, correct?
Do you know the answer to Bob? He asked if you're 70 and a half, you can change your beneficiaries under your IRAs, can't you?
Sure.
Sure.
You can create a stretch IRA after you're 70 and a half.
Beg your pardon?
Can you create one?
An IRA?
A stretch IRA.
Sure.
At 70 and a half?
And after 70 and a half?
We're talking about if you're 70 and a half, stretch IRA has nothing to do with the age, really.
Okay.
It has everything to do with the beneficiary. So you're the retiree and you're getting distributions. At 70 and a half, you're getting minimal required distributions, right? And then you pass away and it goes to your spouse, and then the money in the plan she would take distributions out of, right? Okay, then she dies. Okay, that's when the stretch IRA comes into effect, meaning simply that the kids, if they're the beneficiaries, they have their choice on how they're going to take the money. Unfortunately, it's not our choice. But so the kids would have the choice, and then they would have actually several different choices. Number one, which most of the kids do, what? They take it lump sum. Okay? And you pay what? Tax, all on the lump sum that you take out. So you deducted it, they take it all in lump sum, they pay the tax. Well, the problem that we face in the future is that if you have $1 million